Welcome everybody to this event, and thank you for having us. Well, today I'm coming with Wei Wen, who's in my team. Both of us run Global Macro at Phillip. Okay, so this first slide is basically tells you, well, on one side, okay, it's the assets. So, for example, U.S. Treasuries, emerging market bonds, and then equities, U.S., Europe, Australia. And I mean, basically, this side is basically to tell you that, when we run global macro, it's not because it's very interesting, but basically because, it's something that can be traded, okay? And we run it from the perspective of a trader, and we don't run it from a perspective of an armchair economist, okay? Okay, so let's just look at what we think going forward. But looking back last year, we did pretty okay. We were overweight bonds last year, and that outperformed equities by about 50 basis points. Thank you. Because if it was the other way around, then we would have been wrong. But actually it was correct. So bonds outperformed equities by 50 basis points. And so we were right with the overweight call on bonds last year, and we were market weight equities, which underperformed by 50 basis points. And then we were underweight both commodities and gold last year as well, which actually gave negative returns. Now, gold, we actually downgraded it to underweight on the 25th of October. Okay, so we actually were market weight for most of the year, and then we decided around about October 2012 that things were going to go pear-shaped for gold, and we downgraded it. So I'm glad to say that that call was correct. Okay, so you can see our broad calls are quite accurate, and actually last year was an exceptionally good year for our calls. We got 19 right out of 23, and this year it's a bit more mixed. I think it's, or rather, it's still early, so we could end up being right towards the end of the year, especially for the equity side, which has been a big seesaw for China. And, for bonds, has been paltry returns, and we downgraded bonds, right, to a market weight at the start of the year. And that has given a 0.9% return, so that's over there, right? We've downgraded bonds. And then we upgraded equities at the start of the year, and that has outperformed bonds by about 700 basis points. Okay, and we went overweight China in October, 22nd October and 8th of October for Hong Kong. Now, from those points, that's the kind of return you would have got now. It was, of course, much better, and then the property measures came in, and then we lost about 10%. And then the shadow banking curbs came in, right? And then we had bird flu. So those calls have been whacked down quite a bit. However, we're maintaining our overweight call, and I will go back to China later. Singapore was still overweight, and 4.5% return, which is pretty accurate. Singapore basically has a bit of a safe haven status, and contrary to popular belief, it doesn't follow the Hang Seng, it doesn't follow the the Dow Jones, okay? It does its own thing, right? Okay, so I know I do read a lot of commentaries. Oh, the Hang Seng did this, so the STI followed. I'm like, rubbish, it doesn't, okay? It basically does its own thing. I mean, very different economic underpinnings as well, right? So Singapore is 60% of the earnings. The STI probably comes from ASEAN EM, okay? Whereas Hong Kong is tied very much to China. Okay, on the ASEAN front, we've been market weight Malaysia and overweight Thailand, and we recently upgraded Indonesia a bit late, and we've been overweight Philippines and underweight India. So my part of the section is I'm going to be talking about the US, the eurozone, and China. And then afterwards, Wei Wen will talk about Japan and the ASEAN countries. Okay? And I will also give the overall asset class outlook, which is including bonds, commodities, and gold, okay, which has taken a beating. So let's just start with the thesis. Okay, the global economy is in fragile equilibrium. However, it is expanding, okay? And this year, we think, is still going to be a better year than last year. Okay, the US economy right now is entering a soft patch. Greater China, of course, had some, is also entering a soft patch with the curbs. Okay, but overall, we're still quite positive that the second half of the year will be better than the first half. Okay, on the eurozone, they're undergoing a lot of austerity measures. So I think those economies are still going to, the eurozone is still going to underperform. Okay, so actually, we're not going to be changing our overall outlook. Okay, equities have outperformed fixed income, commodities, and gold, and we are still going to keep that broad call, which is overweight stocks, overweight equities. We're going to neutral weight on bonds, neutral weight on commodities, and we're going to maintain the underweight on gold. Okay, right now, of course, equities have rallied quite a bit, right, since the start of the year, and there is some room for profit taking. Okay, that's because the economic situation now is that we are entering this soft patch, okay, and the markets will price that in, okay, even though it may rally, I mean, the economics may improve to a second half, right, markets will always price in risk as it happens, okay, and so we think that if there is going to be a pullback in equities, right, that will offer an attractive opportunity to accumulate our overweights, which is the US, China and Hong Kong, Indonesia, Philippines, Thailand, and Singapore. Okay, and so there's no change to this view. Okay, so for the US, let's see what's going on in the US right now. Industrial production, as you can see, is slowing. Retail sales is slowing. Manufacturing shipments, which is basically manufacturing sales, is slowing. And the PMIs, they were on an uptrend, and then they were not. Okay? So that's what the US economy looks like now, all right? But that doesn't tell you where it will be. If you want to know where it will be, then you got to look at some more forward-looking things. So forward-looking would be non-defense capital goods orders, excluding aircraft, all right, which has been on this rebound, okay, after entering negative territory last year. So basically, many companies held back their investments last year, right, because of the uncertainty with the budget. Now, some of that has cleared up, and actually there's a bit of a fatigue, right, fatigue with the uncertainty. So I think companies just went ahead with their capital spending anyway. The reason why we've had this slow patch is because of the payroll tax hike, right? That has hit consumers' wallets. And we have an impending debate, still an impending debate on, or well, rather the sequester has happened, right? It has already happened, but there always could be measures to mitigate it throughout the course of the year. Okay, and in May, we're going to be talking about the debt ceiling. Okay, so all these are uncertainties. Anyway, so there you have it. The sequester has happened, the payroll tax cut has happened, so that's why we're in this soft patch. However, if you look at the leading indicators, it actually doesn't look too bad, all right? And housing starts continue to rise, and housing permits also, housing permits, yes, we have that. Also starting to rise, okay? Housing permits, the red line. Okay, the labor market isn't fantastic. So we have the unemployment rate slowly dropping off. And that's also a large part due to the fact that the participation rate has been dropping. So less people are looking for work, so the unemployment rate drops. Okay, in any case, the trend is that the labor market is improving. Also, jobless claims here are on a downward trend. Now, if the Fed is going to say that the threshold is 6.5, then we're going to have easy monetary policy until it hits 6.5. and that is always supportive to the growth outlook. Okay, right now the recent expansion in US equities has been due to PE expansion, so you can see there PE expansion, and not really earnings growth. So this is EBITDA growth. EBITDA growth has actually been slowing. PE has been rising. So most of this rally has been due to PE expansion, right? So whenever you have PE expansion, basically the market is thinking that there's less risk in the system, okay? So we've had some strong measures in Europe, so the risk was reduced. Still, okay, the fact that it is on a PE expansion, I think is, it lends excuse, right, to profit taking if there is going to be one, okay? And in any case, we are still going to be overweight on the US, and we think for these reasons, there is good reason to be positive on the US for the second half of the year, okay, because even though we've had some PE expansion, it's still very much below historical levels, right? S&P 500 is trading at about 14, which is pretty much way below what it used to be, which is about 16, 17. Ongoing capex and housing market recovery. We still have easy monetary policy, and then we have the shale oil and gas boom and EU-US free trade agreement. Okay, Rob, before I go on to China, I want to say that part of the reason why gold is having such a bad time was because when we realized that the U.S. Trade deficit is actually about to improve because of the shale gas boom, that means that's very positive for the dollar, and whenever the dollar rallies, that tends to have a negative correlation with gold. So that was one of the reasons. Okay, so that's with the U.S., all right? It's on the whole, compared to many, many years ago, right, the S&P 500 is not expensive. Okay, however, the recent rally is due to some PE expansion. So if there's some profit taking due to the soft patch that we're in now, don't be surprised. And we do see it as a buying opportunity. So now let's go on to China. Okay, China is in a soft patch as well. So if you look here, China's GDP, the blue line is the sequential growth. So the blue line is the quarter and quarter, right? That's been falling, and on the year on year, okay, that has also been falling. However, if you look at the PMIs, the picture is not so bad, right? On the services side of China, things are just chugging along smoothly. On the manufacturing side, there's been a bit of a rebound. And on the new order side for manufacturing, there's also been a bit of a rebound. So again, although when you look at retail sales, industrial production, and all those standard indicators, it paints a picture of a slowing economy. However, we do put more weight on the PMI because the thing about Chinese figures is that you do wonder about the accuracy. And in my gut feeling, is that we've had years of overstatement, right, of GDP and economic figures, right? Because that's the KPI of the Chinese provincial, right, official, right? That's how they meet their KPIs. So we've had years of overstatement. So now we're going into this moderation, right? I think we can expect that the year-on-year growth would be maybe more accurately reported, and so you'll see deceleration in the year-on-year. However, the PMIs is a direct survey of the companies. They ask them, are things slowing down or speeding up compared to last month, right? And so you get a better picture of whether things are speeding up or slowing down through the PMIs. Now, the other thing is that China's inflation is also under control, so I think we can expect that monetary policy will be maintained, especially since on the property front, also the government is pretty clear that they want to go through sector-specific measures rather than an interest rate hike. Okay, so we're maintaining overweights on China despite the sell-off. So there you go. There's been these sell-offs here, and but the indices are still very, very, very cheap. Okay, and since we think that the Chinese economy is actually improving, we're going to maintain our overweights on that. Notwithstanding near-term downside bias also, because if you do look at the charts, you know, there has been strong downward momentum in the short term. We're starting to form a little base, you know, where we are now. So things could rebound from here, but you know, we'll just have to wait and see, really. Okay, for the eurozone, we're going to maintain underweights. I guess maybe we were a bit, you know, too pessimistic, because last year after OMT occurred, right, and the central bank said we're going to buy debt outright to whoever is willing to, you know, whoever needs it, okay, and bond yields started coming down. Maybe we should have upgraded the eurozone. So okay, so we completely missed that rally. Okay, we're still very stubborn with the eurozone, still not upgraded. It's on an underweight, although that it does look to be on a convincing uptrend. Well, you know, the thing is, we just can't ignore the fact that the economy is really in a doldrums. So if you look at the eurozone PMIs, they are in negative territory and are staying there. There's no rebound. You're basically in a muddling contraction. Okay, so so we're still a bit cautious on the eurozone. Okay, so now let's move on to the asset strategy. Okay, so this details our asset strategy for equities. Okay, so we're maintaining an overweight on the US, overweights on China and on Singapore, Thailand, Indonesia, Philippines, which Wei Wen will talk about later. And these are the ETFs and CFDs that you can use to trade this outlook. Okay, now let's go on to bonds. We're pretty low conviction on treasuries. As you can see, that the very, very expensive at this moment. The yield curve is steepening. Well, they're steepening because the long end is the one that has been rallying quite a bit. Okay, so recently we had a little bit of a sell-off in treasuries. However, sorry, we had the sell-off in treasuries. So we've recently had a little bit of a rally in treasuries. Okay, and that's because, you know, the economy has slowed down a bit. However, we don't think this is sustainable, and you know, given that the U.S. Interest rate is at 0 already, and the only way it can go is up, right? Sometime towards the end of the year. There's very poor risk-reward ratio for treasuries. If it rallies again, then how much upside can you get? Okay, whereas the downside is miles if we get an interest rate hike. Okay, so for mortgage-backed securities, same story, very little upside. Okay, for high yield, okay, this is high yield US. Okay, so actually, although the chart doesn't look too bad, in terms of year-to-date returns, you know, if you look at my first chart again, the returns have been very little, and the main way you're going to get a return from high yield is through the yield. Okay, so because last year there has been such a rush into fixed income, you know, we're not very enthusiastic on it this year, right? So we just maintain a market weight on high yield, and EM Asia debt. We also maintain a market weight, but an underweight for US dollar denominated Asian debt, because Asian currencies have strengthening pressures against the US. And okay, so market weight commodities and underweight gold. So this is my favorite slide because it's interesting. Usually if you think that you want to overweight equities, you would probably want to overweight commodities as well. Okay, because commodities is probably the closest proxy to a growth play as well. So when we redid our asset allocation at the end of the year and decided to overweight stocks but market weight commodities, I guess we have to explain that difference. And the reason is because we do recognize that it's a very slow trudge, muddle along recovery. Okay, it's not going to be a fantastic blistering one, and from that angle, equities would be better than commodities. especially since equities have had to endure such a volatile and punishing 2012, okay, in many ways. And also valuations were not that expensive. So purely on the growth outlook, you know, we had to be market weight commodities. And then underweight gold. Okay, when we underweighted gold in October, so you can see there, right over there, underweight. Yeah, basically, like I said before, it was due to a strengthening US because the US current account deficit is on a narrowing trend, okay, due to the energy boom. And that's good for the dollar and therefore bad for gold, okay? We do recognize that in the grand scheme of things that there's still a lot of QE out there, and you know all the central banks are doing QE. And for that reason, yes, we could have a rally for gold again, okay? However, we're not going to put that down yet because when you have such a strong downtrend, I think it's best not to fight it and let the chart start to stabilize and see how it reacts to economic data going forward. Okay, so we're going to just continue our underweight on gold. And with that, I can move on to actually my colleague Roy will speak first, right? Yeah, Roy will speak first on global markets, and then he will pass you on to Wei Wen.
Hi, good evening, everyone. My name is Roy from the Global Markets Desk from Philips Securities. So I'm actually representing our company here to tell a bit more about Philips Securities Global Markets Desk. Yeah. So let's continue. Disclaimer, yeah, general, whatever I say is my opinion, doesn't represent the company's opinion. Company opinion and whatever serious economic data matters, please look for my colleague Joshua and Wei Wen down there. Yeah. Okay. So, right. So more about Philips Capital. In case you have never heard of us, integrated financial house. We are big in Singapore and growing regionally and globally as well. So established about 35 years ago. Yeah. So pretty big, you can see there. $22 billion under asset management. Yeah, so that's who we are. Okay, so why global markets? So essentially, I believe most of you look at Singapore stocks, trading Singapore stocks, right? If not, you guys won't be in SIAS. Essentially, I did a quick check on what are the number of actively traded counters on the SGX market. So I've been giving a big crowd. I think I wouldn't ask the question. I'll just give you the numbers. Actively traded stocks for SGX is about 700 to 800 typically. Yeah, 700 to 800 typically. So I did a calculation for the rest of the markets. These are some of the markets that we cover. Malaysia. Where's my pointer? Yeah, over there. Short form, Malaysia, Thailand, Hong Kong, Japan, Korea, South Korea, not North Korea. Australia and US. So this market in total, they have about 24,000 stocks available for you to invest in. Yeah, compared to Singapore, you have about 700 to 800. So I always like to say if that one market is in bear or nothing for you to buy, I'm sure out of the universe of 24,000, there is something that you may want to look at to invest. Yeah, so that is the market size that we're looking at. Diversification of exposure. Obviously, Singapore, we have our own, we are very export-driven, manufacturing-driven, so we have certain risk. And if you compare to other countries like Australia, they are mining-driven, material, or rather raw materials-driven. So their investment exposure, their risk profile is different for different countries. Something that you may want to think about. Tapping on opportunities in emerging countries. Anybody know what is the, I guess later on I'll cover the best performing, if I'm not wrong, best performing market in 2012. Anybody want to guess? Okay, anybody don't know. Anyway, I'll cover that in my later slides. Just a teaser. All right, so country and sector rotational plays, obviously mining, telecommunications, green energy are all different sector rotations. You may not be able to get this type of stocks in Singapore, But around the world, globally, you can find these kind of stocks to invest in, right? Access for information, so rather information access for overseas markets. Philips Securities, we allow you to trade in quite a lot of different countries. Information, the fact sheets, and the research from our colleagues are available on our website. I will show you a bit later. Dominance on foreign market and ease of access of trading using our trading platform. Oh, it's a bit small. Huh? I hope you all can see this. This is a bit small. What is this? This is STI, STI, FTSE STI index. It's a bit small, so I'll try and point this. This is the STI. This, incidentally, is a 2-year plot of the STI index over here in white color versus the indexes of various other countries. Yeah, as you can see, Singapore, predominantly we're doing fairly okay, but no, the last year isn't doing too well compared to a lot of the other markets. The red color one, incidentally, it's Philippines. Okay. What else is there? The purple color, Thailand. And they're coming up, shot up a lot. I think if you all follow the currency markets, you all should know it's Japan. Yeah, massive devaluation of currency leading to an explosion in the stock index. So Japan is, since December, a huge bull run. What else do we have? Orange color. Orange color happens to be Turkey. And the green color one is our S&P. Yeah, S&P, US S&P. So you can see that Singapore, although it's still going up, but it's a bit slow. But comparing to the rest of the markets, Philippines and Thailand is actually very hot. And our colleagues is actually advocating the markets, overweight on those markets. Yeah. Okay, just give you a comparison of the indexes. Okay, for us, Global Markets Desk, we cover central dealing activities for 15 markets. It's all there. I won't go through it too much. You can see it from the screen. Major markets that our clients frequently trade is Hong Kong and US. Yeah, Hong Kong and US. Malaysia and Thailand is up and coming. Malaysia is always there. I mean, Thailand is up and coming. Australia as well. Okay, trading platform-wise, we split in terms of online and offline. Online meaning you can log into our Poyum's trading platform. You can trade this market online. Yeah, some of the markets we give live feed, like live streaming price feed, which will be US market, we give live price feed, Malaysia market, Thailand market, and Indonesian market. Yep. Okay, why trade with Philips Securities? Obviously, contra. Just like to highlight, I think some of you all mentioned some of our other overseas competitors. So we always say that they can't let you do contra in that sense. So it's full money upfront, or yeah. So for us, we can do contra. Dedicated dealing team over here. We have dedicated dealing desks in the Asian, US, and UK hours. So anytime you got problem or whatever, you can call our dealing desk. There'll be someone there physically answering your call. In Singapore, not overseas, local slang, not foreign slang. So they'll be able to help you. Custodian services, corporate action, dividend payments, we will cover that for you as well. Settlement currency in Sing dollars. If you're going with other brokers, you may need to TT the money overseas and whatnot. So you don't have a problem with us. Local, regional, and global research, our colleagues are there for you. Yeah, we've been here for a long time. Oh, it's a bit small also, sorry. This is a screenshot of our research portal. All this research here, it's from our colleagues. Sorry, a bit small, but essentially, basically they have research from Thailand strategy, Singapore strategy. What else do we have? China macroeconomic annual reports. Yep, all these things are free for our clients. Yeah, just access the research portal. We also have a very powerful stock screening facility. It's a bit small. I'll read it out to you. These are the markets that we cover for you to screen on the fundamental criteria. America, Thailand, Hong Kong, Malaysia, UK, Singapore, and Taiwan. TSE is Tokyo. Yeah. So these are the markets that you can do fundamental screening on. So for example, I've actually done one here. It's a bit small, but I've tried to screen for Hong Kong stocks that gives operating margin that is between 15 to 50. 15 to 50. So that's what I did. So I want to find companies that are kind of fundamentally strong in their business operations. So can I find these stocks? Yeah, there's plenty of them over there. And you can rank them as well. Yeah, so again, this is free for our clients. So if you have the facility, can go up there and explore. Okay, this is our website, poems.com.sg/global markets. You can get all the trading hours, the brokerage, settlement instructions and whatnots, FAQ, all there. And okay, coming soon. Actually, I was just informed this is launched already this afternoon. Turkey Stock Exchange, we're bringing it out to Singapore investors. Best performing exchange in second best, sorry. Best is Venezuela. Unfortunately, we don't have. So that one is 300% outstanding. So anyway, this one, got it from Bloomberg. So these are the ranking. Out of this list, we have number 2, number 7, and number 10. So these are the markets that you can trade with Philips Securities. And incidentally, at the bottom there, sorry for those at the back, you may need to stand up and see. We have a Singapore-Turkey Investment Forum as part of our launch coming up on 17 May. If you're interested, you can register your interest with my colleagues outside at the desk. Okay, ending part. So just a quick, I guess, roundup. So I guess you all know who is this guy now. Anybody know this? Yeah, Gangnam Style, I think you all know now. So, and then this one is Big Bang. If you don't know, they are another, rather Psy is a Korean superstar, right? Singer, right? So Big Bang is a Korean supergroup in that sense. And 2NE1, they have been to Singapore like last year. Yeah. So they are a super group in terms of the girl band side. And of course, the recently released Gentleman, if you haven't seen it, it's quite interesting video. 80 over million views in 4 days on YouTube, I mean. Yeah. So my point is, Korean entertainment stars all belong to a company, an entertainment company. If you're not clear about the Korean entertainment business, there's 3 main entertainment companies. One of them owns Psy, and the company is YG Entertainment. Yeah, so if you're into Korean stuff, YG Entertainment, you can buy them if you're interested. The other ones is Girl Generation, is under SM Entertainment. We do have clients buying those. And JYP, yeah. So just another side note. Anybody know when, Gentlemen, the single was released? Or don't follow Korean music? No Psy fans here. Okay, this music video, or rather the song, was released over the weekend, last Saturday. Right, so it happened to be I was doing a presentation last week as well on this thing. So I'll let you see what is the before and after effect. All right, so this is 22870, South Korea, YG Entertainment, Mr. Psy himself, or rather he's not, he's one of the artists there. So you can see this was captured on the 10th of April, right? It wasn't released. I think the release was 13th April. Yeah, the stock was trading about, let me see, 71,300 thereabouts. Yeah, so that was last week, last Thursday, last Friday. So what happened over the weekend after the single was released? Yeah, this is the Psy effect. All right, so something interesting to make you hopefully interested in some of the foreign markets. All right, so that's about it. And to end off, we have an account opening promotion for today. We have a Q2 Poems Market Outlook coming up in 5th of May. Malaysia election, I know some of you guys told me, but unfortunately we already booked the date. But you can still make it in time. Morning, go and vote. Afternoon, come and attend. Yeah, so this session will be free for those people who open an account today. If you don't have an account or you want to find out more, do feel free to approach my colleagues outside to open an account. I think that's about it. I think what's next is we'll probably have a 10 minutes break. You can go and freshen up, and then let me see the time here. It's about 8:10, can I say 8:05? So we'll resume about 8:15 thereabouts. Is that okay for everyone? Yeah, so thank you very much. Let's have a 10 minutes break.
Thank you for spending your Wednesday evening with us, especially after work for most of you. Now, this part of the presentation will actually address two questions, right? The first question would be whether Japan, or rather more specifically the Nikkei, is in a structural bull run, right? After the fine run-up in recent months. The second question we want to address is whether ASEAN will continue to outperform after a stellar performance last year in 2012. And during this part of the presentation, we'll try to give you tradable, actionable ideas that you could bring home with, right? Now, in Japan, the key takeaway is this. We are gradually moving from an expectations phase towards a delivery phase. What do I mean by that? A couple of months ago, markets were actually expecting the Bank of Japan, under the new leadership, to actually implement aggressive monetary easing. And the Bank of Japan did not disappoint. In fact, it exceeded markets' expectation, right, and our expectation. So what exactly did Bank of Japan did under the new Kuroda leadership? The key thing to note is that it's essentially changing its operational target from the usual overnight call rate to targeting the monetary base, and they're effectively looking at doubling the monetary base in 2 years. What this means is that there'll be lots of liquidity flushed in the system, right? And also, the key thing to note is that there's also an increase in Japanese bond purchases with a major maturity extension, as well as an increase in ETFs and REIT purchases. And for most of you who monitor currency markets, you will know that the yen right now, or the USDJPY currency pair, is just a whisker away from the psychological 100 level. And we think that a weak yen actually bodes well for the Nikkei. So if you look at this chart here, there's a positive correlation. So the weaker the yen is, the stronger the Nikkei, right? So it benefits, a weaker yen tends to benefit Japanese exporters, right? The question is, after the fine run-up in recent months, whether the Nikkei rally still has legs. We think that the Nikkei rally still has legs, and it could likely challenge the 14,000 level and perhaps the 15,000 level pre-tsunami levels on account of a few things. First, we went through the expectations phase, right? The Bank of Japan delivered, exceeded markets' expectations. So now it's the delivery phase. So what essentially needs to be done is that the Japanese government needs to deliver with structural micro reforms. What do I mean by that? Now, in Japan, most of the industries are actually domestically protected, right? There needs to be an easing or lifting of protectionism, and there needs to be fiscal reforms, without which there's a good chance that the Nikkei or Japan might actually disappoint to some extent, right? So effectively, we need structural micro reforms. And the reason why the USDJPY is not crossing the 100 level is because of the absence of structural micro reforms, which we have not seen yet at this juncture. So once we see signs of the Japanese government introducing such reforms, we have strong conviction that the USDJPY currency pair will cross the 100 level, and the Nikkei will correspondingly challenge the 14,000 and 15,000 level. So for those who monitor the Nikkei, it's actually slipped down quite a bit, right? And we actually advise our clients to buy the Nikkei and the topics actually on dips. Your ETFs, these two are listed on SGX, the Lixor Japan Topics and the MSCI Japan Total Return ETF, as well as CFDs, provided by Philips CFDs. They're actually available for trading, right? So when would pullbacks occur? Now, one good chance is that in North Korea right now, we are seeing an escalation of geopolitical tensions, right? And that could provide an excuse for the Nikkei rally to actually pause, which it's doing right now, right? So for those who are bullish on the Nikkei, for those who are convinced that or confident that the Japanese government will introduce structural micro reforms, which the Japanese economy needs, then you could actually take this opportunity to buy the Nikkei and topics on dips, right? For ASEAN, that brings us to the second question we want to address, which is once again whether ASEAN could actually continue to outperform after a stellar performance back in 2012. The thing about ASEAN is this: ASEAN offers rather the opportunity of tapping to a very resilient domestic demand. So right now in major ASEAN economies, like from the Philippines, from Philippines, Malaysia, Indonesia, Singapore, we have massive infrastructure boom. So in Philippines, there's this public-private partnership where the public sector and private sector are cooperating to actually build massive infrastructure for economic growth and stuff. In Malaysia, we have the Economic Transformation Program, which some of you might be familiar with. For Indonesia, there's also massive public infrastructure works that extend from public roads, MRT, and monorail network. Closer to home in Singapore, we are doubling our MRT network. We are having new port facilities. We are building new port facilities in Tuas and Pasir Panjang, and of course, Changi Airport Terminal 4. So in a nutshell, what we are seeing right now is that major ASEAN economies, they are in fact undergoing an infrastructure boom, right? And the thing about ASEAN is this: there's favorable demographics, the rise of the middle class, as well as an upswing in the investment cycle, right? As what we are seeing right now in the infrastructure boom. And also there's a domestic consumption, which is largely fueled by the rise in the middle class and structural transformation, particularly in Indonesia. That's why Indonesia has, year to date, has actually garnered quite a fair bit of returns. And apart from intra-regional trade, should the global economy rebound in the second half, which is what we mentioned earlier on in the first part of the presentation, there could be also a boost to ASEAN. So the investment action essentially is actually to stay focused on Asian equities. So we have Greater China equities on compelling valuations, ASEAN equities on middle-class consumerism, on an infrastructure boom. So year to date, MSCI Southeast Asia, right, has closely tracked MSCI World, right? So MSCI Southeast Asia about 6.2, MSCI World about 7.8%. And also Asian fixed income, which you could actually trade using ETFs, right? They would actually enjoy positive spillover because Asian currencies tend to be quite strong also. So apart from fixed income returns, you could also gain from currency translation gains. So once again, in our ASEAN strategy, we actually overweight Philippines, Singapore, Thailand, Indonesia, and we are market weight Malaysia, which we might overweight if the Barisan Nasional gains a strong mandate on 5th May. This slide shows the ETFs, which are listed on SGX, as well as CFDs, which are provided by Philips CFD department that clients can actually trade with. Now, closer to home, let's start off with Singapore. In Singapore, we're actually expecting modest growth of GDP growth around 2%, and high inflation of around 4%, right? And we think that it's likely to be the new normal, right? The new norm, as the Singapore economy restructures and the focus now shifts to inclusive growth, right? Domestic-oriented industries such as your construction sector would tend to be the main driver of growth, right? Amid of the pipeline of infrastructure building that we discussed earlier on. External-oriented industries such as electronics will be weighed down by sluggish external demand. So in fact, this morning's NODX figures, non-oil domestic numbers, they showed that electronics shipments are still in the doldrums, although the pace of decline has stabilized. In the US, the semi-book-to-bill ratio is above 1. What this means is that global demand should pick up gradually, and then that lends support to our thesis of a second half rebound, all right? In terms of monetary policy action, we expect MAS to continue to stand pat, meaning maintaining a modest and graduation appreciation of the Sing dollar, mainly to anchor inflation expectations. So what does this macro backdrop translate to mean for Singapore corporates? What this means is that for Singapore corporates, they will actually essentially be facing a slower top-line growth, right? But higher wages. They need to pay out higher wages. So there's a possibility of margins being squeezed. But we are still overweight Singapore on account of the following. The first is this. Singapore sovereigns are actually one of the few AAA quality investment grade rating around right now, right? And they offer relatively attractive dividend yield of around 3% based on MSCI Singapore. There are currency translation gains to boot. At this juncture, I think the USD/SGD has fallen below 1.234, right? And Singapore also has significant exposure to EMs and ASEAN, which will actually mitigate any slowdown in advanced economies, which Joshua alluded earlier on. Our Singapore equity strategies top picks are actually SIA-EC, which we think would be a key beneficiary of the regional aviation growth story. Pan United Corp, which rides on the infrastructure boom, as well as having a stake in one of the top 10 ports in China. And Balsted, which have exclusive distribution and service agreements in Australia, Singapore, Malaysia, and Indonesia with the global leader in geographic information system. So these are our three top picks, and Joshua incidentally happens to cover Pan United and Balsted, right? Moving on to Thailand. Thailand is an interesting story because if you recall, it was not long a couple of years ago where it was hit badly by floods, right? Devastating floods. But since then, it has rebounded very strongly, right? Largely due to strong infrastructure rebuilding. But post-floods, what happens after the floods? Post-floods, I think in the next 12 months or so, we have strong visibility of investment commitments, right? And thus, we still remain positive on Thailand. And in fact, our Thai equity strategies expects about EPS growth of about 14% year on year. But we think that we caution that returns essentially will actually be moderate right now because of stretched valuations, right? Bank of Thailand is likely to stand pat after cutting preemptively October last year. But should there be a need to cut, we like to advise that there's ample room for Bank of Thailand to do so, and there might be even additional fiscal measures announced to boost the economy should there be a slowdown. Our Thai equity strategies preferred sector is actually banks, and her top pick is actually Krung Thai Bank, which you could actually trade with global markets platform, which Roy actually shared with you earlier on. Moving on to Philippines. Philippines is essentially in a sweet spot. As early as last year, we have written our reports that there's a good chance that Philippine sovereign might be actually upgraded to investment grade. And in recent weeks, Fitch has actually upgraded, but we think that there'll be limited upside, as most of the investment grade upgrade has already been priced in by markets, especially the strong performance last year. But still, Philippines it still enjoys resilient domestic demand, strong infrastructure boom, record low interest rates, right, and healthy remittance inflows. That will lend support to the economy. The thing to worry about in Philippines is that of an asset bubble, right, as well as the implementation risk of the public-private partnership program that we spoke about, the infrastructure building, which might be delayed due to bureaucracy. And we think that the central bank, although there's no need to cut rates to boost growth, but it might cut rates to actually moderate the appreciation of the Philippine peso, which has been quite strong and actually be effectively weighing on its exports. In Indonesia, we recently upgraded Indonesia from market weight to overweight, in part because that we think that the pace of rupiah depreciation has actually eased. So it's around 9,700 to the US dollar right now. But this easing of the rupiah depreciation is largely due to Bank Indonesia interventions. So on this chart here, what we are seeing is that Bank Indonesia actually intervened quite strongly with its reserves to actually prop up the rupiah, right? And although that the Indonesia is currently in a strong investment cycle with a healthy domestic demand, there are a couple of things to actually be cautious about. The first is this. Last week, Bank Indonesia actually stood pat. They maintained their rates at record low rates. But for those who actually keep an eye on the Indonesian economy, they'll know that in Indonesia, you have a lot of fuel subsidies, which is actually posing a strain on the government's finances. So eventually, the Indonesian government has to scale back such fuel subsidies. And by standing pat last week, Bank Indonesia actually risked the possibility of a steep rate hike later on in the year. So that's one thing to actually be aware of. There are also a lot of policy uncertainties ahead of the elections next year in 2014, the presidential elections. And so that's another thing to take note. But for now, we think that MSCI Indonesia offers good value as compared to our overweights in Thailand and Philippines, which have become relatively expensive. Moving on to Malaysia, we are market weight right now. The key policy risk is a political regime change, right? So we know that on 5th May, Malaysia goes to the polls, right? Voting comes in. The thing is that in the event that the incumbent Barisan National Party fails to reclaim the strong mandate, the ETP program that we spoke about and the government transformation program, which involve a lot of infrastructure building and stuff like that, and they are major pillars of the domestic demand story, they might be confronted with headwinds, right? But having said that, at this juncture, markets have actually priced in Barisan National retaining a simple majority, which is 50%. A strong mandate would be translated to 2/3 majority, right? The key thing to note is that even if the opposition garners an outright victory, Malaysia's resilient domestic demand driver would not actually fundamentally change overnight. So that might be an opportunity to enter the market if, such a scenario materializes, right? Right now, the KLCI, like we have mentioned on our Monday weekly webinars, it's broken above the 50-day and 200-day moving average support level, so it's trending up. But we expect some jitteriness, some nervousness in the markets closer to 5th May as Malaysia goes to the polls. So in short, ASEAN offers a resilient domestic demand, especially when the global economy is undergoing a soft patch in this quarter of the year. I'd like to draw attention to this column. This column essentially shows that most central banks across ASEAN economies have actually stood pat since last year, and some even in 2011, when you have your G3 central banks actually undertaking aggressive loosening. That reflects ASEAN's resilient domestic demand, right? Essentially. But looking ahead, we think that the growth inflation dynamics will get trickier for policymakers. In fact, we are already seeing some signs of asset, or rather property bubbles, arising from a strong surge in capital inflows, particularly in economies such as Indonesia and Singapore. This chart here shows the performance year-to-date spot return of the ASEAN currencies against the US dollar. So if you were to buy, let's say, our Thai equity strategies, preferred sector, let's say banks, not only could you garner a capital return, you could also gain some currency translation gains. This thing to note is that year-to-date means from 1st April 2013 to 15 April. But last year, most ASEAN currencies were actually stronger against the US dollar. So this chart actually shows that the US dollar is structurally stronger for the reasons that Joshua actually alluded earlier in his first part of the presentation. But nonetheless, they are holding up against the US dollar. They have not come down steeply, in fact. And there are actually gains to be made, currency translation gains to be made in the Thai equities, which you can tap on with global markets platform that we offer. So in short, in terms of the summary of our today's presentation, I guess we could narrow it into a couple of key points. The first is this, as Joshua took you through in the first part of the presentation, essentially we think that markets have actually ran ahead of the economy, right? The US economy, the Chinese economy is entering into a soft patch right now, right? And so, clients often ask us this question, should we sell in May and go away, right? The thing is that, the question that we like to pose is that April, would it be the new May, right? Essentially, the thing is what we're trying to put forth is this. We think that the risk of profit taking and subsequently the risk of a correction in the second quarter is very high, right? And already we are seeing some signs of it. But having said that, we think that dips or retracements actually offer an opportunity for our clients, for investors like yourself, to actually accumulate our overweights once again in the US, greater US on capex recovery, accommodative monetary policy, greater China on compelling valuations, notwithstanding the near-term weakness, ASEAN on resilient domestic demand. So these are economies that you could actually take a look at. These are economies that you could actually trade the outlook with ETFs or Phillips CFD if you do not have a view on specific equity. If you have a view on a specific equity, let's say a Thai equity, then you could go to your global markets platform and trade it with them. With that, I end our presentation. And before that, before we take questions, we would like to advertise this. Coming May, we actually have, coming July, we actually have an event that is Philip iFest 2013. It was a sell event last year, right? Mike Bellafore came down, right? It was a sell event. So tune in soon. Do not miss out. The website is here for those who are interested, and these are the topics that we covered. With that, we'll be happy to take any questions if there are any. Myself and Joshua will be happy to take any questions. You could ask us anything about asset, strategy, goal, whatever.
Yep. Question there.
Joshua, can I just check with you earlier in your slide, you mentioned about a rebound around second half onwards, correct? 2030. Right now we are sometime around, we are in mid-April, so from now to then, in terms of time frame, second half onwards is not that far away. I reckon, so it's about 1.5 months. At this point of time, I think SEI is quite narrow, trading at a quite narrow band. So do you reckon that you are still quite bullish in the grander scheme of things? Do you know when will QE through yet? I mean, not you know, I mean, you evaluate or assessment.
Yeah. Okay, so the question is that, okay, so we're going to have, we think, like, okay, there's going to be some kind of a rebound in the second half, and we're actually quite close to it now. So that's what you suggested, and that the STI is trading in a narrow band, right? So I suppose what you're really wanting to know is that next leg up for the STI coming. Is that what you...
By and large, yes, it will go along.
Yeah.
If it rebounds,
Yeah, I mean... Okay, so like I said, the STI actually is a bit of a defensive index. So if there is going to be a correction, we reckon it's not going to be very deep, okay, and it would be a buying opportunity. Obviously, right now broad markets are looking a bit weak, so it could come and or we could have the scenario where even though economies are weak, the markets just completely ignore that and look ahead. Very possible also. Okay, so we have we have a view, okay, but it's very hard to say whether it's actually going to correct imminently. Okay, so what we have actually is our morning commentaries. Okay, on our morning commentaries, we not only talking about economics, we also look at price action and technicals. Okay, so right now, I don't think there is a suggestion that there's that the correction is like tomorrow or something like that. But I have to tell you that it's that the price action is looking neither here nor there, and momentum is also not exactly picking up. So yes, it's vulnerable. Okay. Now on QE3, if QE3, when is it going to end? I mean, yeah, hard to say. Maybe next year. I would, if we have a ballpark estimation, maybe I don't know, middle next year, end next year, yeah, something like that. So when that happens, most people are saying that, there's going to be such a terrible risk-off event, and equities will just sell off because the whole thing is this liquidity-driven rally, right? Okay, I grant you that I think that there will be a bit of a panic. Yes, QE3 is about to end, and maybe markets will sell off. However, I have to say that when QE3 ends, that is actually a signal from the Fed that the US economy is strong enough to be without QE3. Okay? Basically, the Fed is saying, we don't need QE3 anymore, right? The US economy is fine and dandy, right? And in that scenario, if there is going to be a sell-off in stocks, it's going to rebound again, right? And the worst place to be is actually going to be in bonds, right? And if the worst place to be at that point is going to be in bonds, where is that money going to go after you sell off your bonds? Is that you're going to buy stocks. Okay? So actually, I think the risk-off is going to be short, right? And then there might be a huge rally. Okay, so we'll have to see what happens at the time. Maybe at the time when they say we want to withdraw QE3, and we're also looking at the US economic data, we might actually think that, man, maybe they're making a mistake. We still need it. Okay, so there might be policy error at the time. Okay, but I'm thinking that if it's not a policy error, actually, a knee-jerk sell on stocks and then rally again, because most portfolios would then be like selling off their bonds, okay, and then where they're going to put their money, they're going to buy stocks. Anyway, yep, same.
You mentioned just now that China indices is looking a little cheap, quite inexpensive now. What's your take on STI?
The STI is also actually not that expensive. I think it's about 14 times PE, the STI. Do we have it? Yeah, we do. Yeah. The STI is also not expensive. From the chart, it says about 11 to 12 times.
PE.
Yep, PE. Okay, so also the STI has good yields, right? A lot of the companies there have good yields. So yeah, we're overweight the STI. We're actually pretty bullish on it. And we like the fact that it's defensive as well. Yeah. Any more questions? I wouldn't be buying either of them at the moment. Oh, if you have a rebound, yeah, you buy silver because it will. What's the outperformance? Twice or something like that, right?
I guess broadly speaking, I think silver tends to be more volatile than gold.
Yeah.
So whether you enter a long position or whether you enter a short position, if you are an intraday kind of person, silver is definitely the instrument.
Yeah.
Right? The margin you have to put forth is also smaller as compared to gold. I mean, for those who trade gold or silver, don't know. Right? But having said that, I caution that trading gold and silver, especially on an intraday basis, is largely a very sentiment-driven kind of thing. Right? So, yeah, you have to be careful of that.
Yeah. So, yeah, we're underweight gold. We have been underweight gold since fourth quarter of last year. And one of the things that we always get is that how can you be underweight gold? All this money printing. Surely you must be overweight gold. And okay, so we mentioned one thing, right? Is that actually the US dollar is not as bad as it looks because the deficit is narrowing, And also, after all that money printing we've had, you know, with Japan and then the ECB threatening to do so, and of course, you know, Bank of England doing it, you know, gold just has not reacted the way it was supposed to. Okay, and when the charts all start looking shaky, you know, and then we see the current account deficit in the US narrowing, something's not right, okay? And I hypothesize, you know, why it's not right is actually that despite all the money printing, is that risks in the system have actually reduced, okay? So if you think about why a company does a rights issue, for example, you know, rights issue is terrible for the share price, isn't it? It's terrible. Okay, so usually, okay, is the price will tank. But let's just say you have a really lousy company that has, you know, horrible NTA, you know, and is, you know, it's got debt and everything, and then it does a rights issue. Okay, I have seen instances where actually the price rallies. Okay, why? Because the risk in the balance sheet has been reduced through the rights issue. And I think part of the money printing has actually done that for the global economy. So, you know, it has completely flipped what the expectations were, you know, in that sense. Yeah. Yep.
Gold find its level, because I remember at $1,000 per ounce, the Indians and the Chinese are mopping up central banks to buy gold.
Yeah. So, yeah, actually a lot of them have lost money now, you know, because a lot of them were buying gold last year for the same reason, you know, it's like, oh, everyone's making money, so I better buy some gold, you know, and now lost money, okay, and it's the support level for gold, actually it's hit the support, it has hit a major support level of 1,003, right, if I'm not wrong, you know, the last I saw the chart, you know, it has actually bounced off the support level right now, and given such strong selling momentum, you know, if there's a rebound, my instinct would be to sell into strength, right, and to short it into strength. But at the same time, yes, there is a lot of strong sentiment out there for gold, you know, and yes, there is a lot of money printing. So, okay, so we've done like one round of rights issue, right? You want to keep doing it? Okay, then that will really kill the price. Okay, so they can't excessively do it either. So at the same time, you know, the risks in the system reduce. We can go overboard with this money printing, and then it would eventually be good for gold, right? So I think at this point in time, our stand will we'll just watch the charts. We'll just watch the charts and see how it reacts to the economic data coming out. Any more questions? Yep.
The commodity prices have recently taken a dip, and a lot of the stocks, local stocks related to commodities, have actually taken a beating. What's your opinion? Will it pick up commodities?
Yeah, that's a tough one. I mean, given that we believe that the second half will have a rebound, right? So we should actually believe that at some point commodities will rebound with it. Okay, so that's why we've put a market weight on commodities. It's not quite an underweight, right? Because, I mean, if we underweight commodities, that means our outlook on the economy is pretty poor. Okay, so, yeah, so I haven't totally given up on commodities yet. But should it start breaking key support levels, then actually that kind of tells me that maybe my second half economic rebound theory is wrong also. Okay, because, you know, we have to take note of that kind of asset price signals. But for the moment, yeah, we do think that, you know, given our outlook for the economy, you know, we should see commodities stabilize at some point. Any more questions? Yes?
What will be the impact of rising interest rates on Asian and Singapore bonds?
You want to answer that?
I guess when you mention rising interest rates, you'll be talking about rising rates in the Fed, right? Now, for those who follow the Singapore property market, you will know that our SIBOR is closely linked to the Fed funds rate, right? So the reason why you're seeing a lot of these policy tightening measures by the government right now is that the government is actually concerned about citizens like us. We are over-leveraged on property, about mortgages, and we could be caught wrong-footed if interest rates rise. So the short answer to your question as to the impact of interest rates on Asian economies like us is that it will definitely affect our property market, that's for sure, right? It would also actually, to some extent, affect your, how would I put it? It would to some extent affect your appetite for risk-taking, right? Because interest rate rise, the cost of investments also rise, right? So, and that, to some extent, could actually curb companies' investment plans and stuff like that. So this would be some possible channels of a rising interest rate, the impact of such to economies like us. Yeah.
Any more questions?
So how many of you are going to long go after the steep decline? Are you sure? It's so attractive right now. Right. I think adding on to Joshua's point, now gold actually, like what he mentioned, Joshua mentioned, it has found support at 1,003, but if it breaks below that support, the next support actually is 1,279, right? I'm not sure, I think some of you might be aware, or might ponder actually why gold has actually declined rather sharply in the past few days. Now, for those who have been following gold, which we have been following closely, what we notice is that if in the US, they often publish data on net long, net short positions on gold, right? So earlier this year, there was a huge net short position, right, by major institutions, for those who actually look at the CFTC data. And so SocGen actually fired the first salvo with their strategies saying short. CT follows suit, saying short gold. And then Goldman Sachs, in the report, laid the final nail, short. And then markets actually tumbled down quite a fair bit. And that's where these people who actually shorted, which are your big boys, they actually sell, get rid of their positions, buy back. So that brings me to my point that gold, especially in a very short-term horizon, is rather a sentiment-driven play. So notwithstanding that there are fundamentals behind, but you have to make your own judgment here and there. We'll be happy to take any questions if there are any.
Bird flu.
Now, I guess for those who remember...
Run for the hills.
Yeah. Are you still eating chicken? No, I guess on a serious note, for those who remember the last time we had some incident like that, there was a decline, but we also recovered strongly also. But what makes this time different, as we've discussed previously, is that China is increasingly more transparent about publishing data of the people who actually are affected with and who actually died from this bird flu. At this juncture, there's still no evidence of human-to-human transmission, which is a clear positive to some extent, right? So in short, there could be some jitteriness, but then I think the extent of which negative would be quite limited to some extent.
The slide shows that there are a couple of overheat in some part of Asia. So what is the chance of the Asia financial crisis?
Okay, I'll take that, and then Joshua maybe I'll add on. Now, Asian financial crisis hit us back in '97. So the bigger question is, what has changed since '97, right? The short of it is that Asian markets, especially that in Thailand, right, which was hit severely back in '97, if most of you could recall, the Thailand financial system has actually deepened, liquidity-wise has deepened. So you would not see that kind of panic sell-off that we saw in 97. But having said that, risk assets, especially which include equities, by and far are very sentiment-driven. So you could see a huge pullback, right? So who remember that when CT fell to $1, who went to buy? That kind of thing. So it must, when people are panicking, you should based on fundamentals. So like Asian economies like ASEAN, for example, they still have resilient domestic demand, favorable demographics, the rise of the middle class. So these are strong fundamental stories, growth stories that cause us to be overweight on these economies. So yeah, they are.
Yeah, also the other thing is that, Asian companies are a lot less leveraged than they were during the crisis, right? So, we don't expect that kind of, if there is going to be a bubble, let's just say, there is some kind of a bubble going on, and it pops, I don't think you're going to see that many companies go under as well. It's interesting that you alluded to that, because actually there is a bit of a credit expansion going on in ASEAN right now. Okay, so we will just have to monitor that it doesn't go ahead of itself, right? The other thing also is that the expansion during the 90s, there were not a lot of productivity gains that were commensurate with it. Okay, so on the other hand, we do see Thailand, Indonesia, and Malaysia. The industrialization process is going on. Okay, so again, that's different from what it was before. And now central bankers are a lot smarter. Back in the 90s, not that many of them went to, not that many of them had that kind of experience, so that's quite different from where it is now. If you look at the way in which ASEAN central banks have controlled monetary policy, actually they've been rather astute so far, right? In raising interest rates where they see inflation picking up and reducing it when they see it come down. Yeah, thanks. Okay, if there are no further questions, you can meet us outside at our booth and mingle. And thank you all for being here, and good night. Thank you.